All right, you guys, welcome. Doug McKay on the 5th of April, 2012. Have a happy weekend, everybody, holiday weekend. Close at 1397.77. We are below 1400. We have yet to close above 1420. We see this as in a range right now between 1390 and 1420. Above 1420 is good. Below 1390, we'd want to sit up on our seat. For our purposes right now in the managed accounts, we are hedged. We are using the Dow. We'll flip over to that in a minute. What we don't want to do is take this down to 1370, which is the 50-day moving average. Quite possibly when we look at this on a weekly chart, at some point we believe in very high probability that we will be going to 1350 on the S&P cash at some point in 2012. That's not to say that we won't move above 1420 and break out to 1450 first, but what was once very good resistance, once we broke through that resistance of 1350 now becomes support. So we think we're going to come back down at some point and test 1350. What we don't want to do at this time is, if these candles are starting to roll over on a weekly and on a daily chart, is take this down to 1350. As a matter of fact, we don't even want to take it down to 1370. So we're going to stay in this tight trading range, or as we stay in this tight trading range, we're going to be hedged. Hopefully we won't experience a lot of whipsaw, but if we do, we do. So again, for the purposes of the S&P 500, above 1420 is good, and below 1390, we want to sit up on our seat, because it's quite possible that we'd be taking this down to 1370 and then 1350. You can also see there's good support at 1380 as well. Let's take a look at the IWM. This is something that we wanted to get long on if it got above 84 on a close. Why? We mentioned this last week and the week before. Nice cup and handle, inverted head and shoulders pattern. We got above 84. We did not take the trade because it gapped up. We wanted to wait for the gap to fill and then see how the chart played out. The gap not necessarily will fill in a day or two, but it did in 2 days here. Again, we'd want to reset the trade where we'd want to see a close above 84. That never happened. As a matter of fact, today we closed below 82 at 81.57. We see the Russell is in correction. We are below the 50-day moving average. Until we get back above 84, we'd be sitting out of the Russell. If we get above 84, we'll get long the Russell. What else? Gold. The overall trend in gold remains down. We put out a weekly chart yesterday, saying that we should get a bounce in gold, which means you should get a better opportunity than here to short. That doesn't mean it's going to happen, but the odds are that it will happen. In other words, that there'll be some type of bounce in gold at a minimum to fill this gap. Until we get above 166, which is probably 1700 on the spot price, possibly even the June contract on gold, I would be sitting out of the long side unless you're playing a bounce. Any type of bounce that you play right now in gold or treasuries or crude, I would have my stop under the previous low, which in this case would be yesterday's low. Let's take a look at oil. Same thing here. If you're going to play a bounce on oil, make sure that you have your stop under the low that was put in most recently, which would be yesterday. This is still trending down. We're seeing a series of lower lows and lower highs. We are also below the 50-day moving average. Could we bounce up to 2640? Yes. But again, this is something very similar to what we talked about a couple weeks ago. Until we get a clear shot above 2760, this is a trader's market here. And if you're going to play any bounce, again, have your stop under the lows that were put in this past week, which in this case, again, would be yesterday's lows. Let's take a look at TBT, short treasuries, double short treasuries. Earlier in the week, I was a little disappointed that this ran away from us, but I didn't want to chase it here on this day when the Fed minutes were released. So what we did is we let it go, and probably the lesson here, and the reason I'm bringing this chart up, not necessarily a lesson, but something to be aware of, is if you don't recognize, or at least for my purposes, if I don't recognize a chart in 2 to 3, maybe 4 seconds, I let it go. Because what you don't want to do is sit there and try to figure a chart out. If you don't see it, don't take it, move on to something else. At this time, this is really nothing that I see in clarity, especially with the moves lower in interest rates, which coincides with a move up in treasuries this week and a lower move down in TBT. So what's my point here? I don't see a clear trade if you are flat in this at this time until we get above 2080, maybe even 2090, which is right around the top or very close to the top of this bar. One way you can check your homework with that is look at the inverse. We'll look at the TLT and the IEF. Clearly the trend in treasuries is down. However, we could be looking at an ABC pattern here. A, B, C. Where is C going to go? If in fact it continues to go, probably 104.40, maybe 105.20. Again, very similar to what we just mentioned on gold and crude, is if you're going to play a bounce and get long treasuries here, whether it be the IEF or the TLT, have your stop nice and tight, especially percentage-wise, right? About 1% back under the lows that were put in on Tuesday. All right, let's flip over to TLT. Same thing. Again, this is a bearish pattern where we could bump up to resistance here, where we broke support at 115.50, which is now resistance. But at the same time, if you're looking at this for a trade versus a long time hold, I would have a stop in place just under the lows that were put in Tuesday. And again, that's within about 1.5%. So we could be bumping up here. We initially filled this gap, rolled over. That was nice how that played out, but maybe we're going back up again. So if we get above 114.40, there's going to be some people shorting treasuries that are going to get squeezed that may give this C wave a little more room. All right, so we'll keep an eye on that. Again, for quite a while now, at least in the managed accounts, no position in gold long or short, no position in treasuries long or short. We have been out of oil. We are just in equities, and we are hedged basically 1-for-1 in equities. We want to see what happens next week, as to whether or not we get above 13,250 or we come back and break support at 13,000, short-term support at 13,000. This looked nice last week. It looked like we were going to push right through 13,250. This is something else I want to point out as well. Let's take a look at the Dow. We'll flip over because this is a cleaner chart, I believe. Or not the Dow. Let's take a look at the diamonds. And what we want to be aware of here is this could be a head fake in here where we could possibly experience a false breakout, very similar to the Russell. This necessarily was not necessarily a breakout, but we did have this move intraday on Monday where the high was 132.68. And let's see if it took out the previous highs of 132.61 back on the 16th of March. It did. So there might have been some stops parked here, getting short in through here, and then they were taken out intraday. Hard stops here that were taken out intraday here. So what we want to do, or what we're looking to do, is if we get above 132, or let's say 13,250 on the Dow, that would increase the odds that we're going higher. But at the same time, if it's a false breakout, we want to have our stop tight right around 13,000. So this is kind of what we're doing right now in the managed accounts. We're between 130 and 132. We have a hedge on whichever way it breaks, we'll let the other one go. So the overall trend, you guys, is moderately bullish. That could change next week. Moderately bullish means if we have to call a trend, we're going to still call it long. But cash is not a bad place to be at this point. This could be the beginning of a slow rollover. We'll know more next week when everybody comes back on Monday. All right, you guys, that's it. Doug McKay, antiwallstreetguy.com. As always, we'll take a look at a chart of the S&P 500. Through 1420, the upside is good. 1390, last week's lows we're keeping an eye on. For our purposes, again, we don't want to take it down to the 50-day moving average or even lower at 1370. Even if we've got to get back in at a higher price when it gets above 1420, if it does at some point, we're good with that. All right, you guys, we'll see you. Enjoy your weekend. We'll see you Monday. Thanks.